The debt illusion, how money became a promise in chains. 1. The hidden nature of money. Every dollar looks like wealth. It feels solid, reassuring, and free. Yet, the uncomfortable truth is that it's not wealth, it's an IOU. Each bill represents someone's obligation, a loan, a bond, a mortgage. The modern financial system runs on debt disguised as money. So what does that actually mean? It means every piece of currency in your wallet is a promise to pay back, not from you, but from someone, somewhere. The more promises created, the more money exists. The illusion is that money gives freedom, when in reality it records dependency. Footnote. Modern money functions as credit, its existence depends on corresponding debt obligations. 2. Banking's greatest trick. Most people believe banks lend out deposits. It's a comforting story, savers fund borrowers, and the economy hums. But that story belongs in a bedtime book. In truth, banks create money the moment they issue loans. When someone borrows $100,000, that sum is typed into existence, not transferred, created. The catch? They owe it back, plus interest. Multiply this by every mortgage and credit card, and you'll see the paradox: the money supply grows only when debt does. Stop borrowing, and money disappears. The entire system must run faster to stay alive. Footnote. Commercial banks generate new money through lending, making debt expansion essential for liquidity. 3. Governments and the perpetual borrowing machine. Governments follow the same pattern. When expenses exceed taxes, they issue bonds, promises to repay with interest. Investors buy these bonds, and voila, new money enters circulation. But that money, too, is born chained to debt. Future taxpayers are the collateral. Like a shark that must keep swimming, the financial system must keep borrowing or collapse. So what does that actually mean? It means growth isn't a measure of prosperity, it's a measure of expanding obligations. Footnote. Sovereign borrowing perpetuates a debt-based monetary supply dependent on constant expansion. 4. The consequences of infinite credit. Endless debt creation comes with hidden costs. Inflation erodes savings. Inequality deepens as lenders and asset owners profit while borrowers sink. The worker, the small business owner, the saver, they feed a system tilted toward those who issue credit, not those who earn it. And the cruel irony? Even your savings account represents another's debt. It's wealth that only exists because someone else is still paying for it. Footnote. Inflation and inequality are structural byproducts of interest-based monetary expansion. 5. When kings canceled debt. History didn't start this way. In ancient Mesopotamia, debt grew like weeds until it threatened to consume entire kingdoms. The solution? Debt jubilees. Kings wiped the slate clean, not from kindness, but survival instinct. They understood that societies built on unpayable obligations collapse. So what does that actually mean? It means even ancient rulers grasped a truth we've forgotten: perpetual debt is a slow form of societal suicide. Footnote. Early civilizations instituted debt cancellations to prevent systemic collapse from compound obligations. 6. Sticks, metal, and paper. Medieval England used tally sticks, split pieces of wood marked with notches for taxes owed. One half stayed with the crown, one with the payer. No interest, no inflation, no debt spiral. These wooden receipts circulated as trusted money for centuries. Later came gold and silver coins, whose value lay in metal, not promises. Stable? Yes. Flexible? Not so much. Flood the mines, prices soar. Run out of metal, economies freeze. Every system solved one problem while creating another. Footnote. Pre-modern monetary systems alternated between commodity-based and credit-based structures, each with trade-offs in stability and flexibility. 7. The rise and fall of debt-free money. Even modern nations flirted with freedom from debt. During the U.S. Civil War, the government issued greenbacks, paper money created by the Treasury, not borrowed into existence. It worked. Soldiers were paid, goods were bought, and the economy held together. But bankers lobbied hard to end it. Why? Because greenbacks earn no interest. Later, other nations tried similar experiments, some thrived, others inflated themselves into ruin. The lesson? Money works when managed with integrity, not ideology. Footnote. Directly issued sovereign currencies demonstrate that debt-free systems are viable under disciplined governance. 8. The modern alternatives. Not all innovation needs a crown or Congress. In 1930 Switzerland, small businesses built the Wehrbank, a mutual credit system without interest. Carpenters, bakers, and merchants traded through ledger balances, keeping commerce alive without debt. It still exists today. Across the world, communities use local currencies to retain wealth within their borders, the Bristol pound, the Berkshire, countless others. And then came Bitcoin, the rebellious child of the 2008 crisis. Capped, decentralized, and not born from debt. For some, it's liberation. For others, an unstable gamble. But it proved the point, money doesn't have to be born in bondage. Footnote. Alternative monetary systems such as mutual credit, local currencies, and cryptocurrencies demonstrate non-debt-based exchange models. 9. The digital dilemma. Governments now explore central bank digital currencies, CBDCs, issuing money directly to citizens. Sounds liberating, right? Until one remembers, programmable money can expire, restrict, or monitor. The same tool that cuts out banks could also cut out privacy. So what does that actually mean? The promise of freedom could easily become digital servitude, depending on who writes the code. Footnote. CBDCs may reduce systemic debt reliance but introduce surveillance and control risks. 10. The bigger lesson. Debt-based money isn't destiny. It's design. History proves that money can mean trust, labor, or tangible resources, not merely obligation. The tragedy is that our system persists not because it's the best, but because it's profitable for those at the top. Banks earn interest, governments borrow instead of taxing, and citizens are left to pay the tab. Yet the cracks are visible. Global debt now exceeds $300 trillion. Inflation bites. Inequality grows. The treadmill accelerates. So what does that actually mean? It means the system will change, by reform or by failure. The question is whether we'll understand it before it resets itself. Footnote. The global debt crisis exposes the instability of perpetual credit creation, demanding systemic redesign. 11. Choosing a new design. The path forward isn't nostalgia for gold or blind faith in blockchain. It's about reimagining money as a public tool, not a private leash. Systems like tally sticks, greenbacks, and Wehrbanking prove alternatives can function when trust replaces interest. Humanity already reinvented money countless times, it can do so again. The real question is courage, not capacity. So what does that actually mean? It means the next version of money will mirror our collective values. If we keep worshipping debt, we'll keep living in it. If we build for freedom, we might finally earn it. Footnote. Future monetary reform depends on public will to prioritize trust and equity over profit and control.